If you trace the word mortgage back to its roots in medieval law French, it translates literally to death pledge. Think about how wild the modern version of this pledge actually is. A financial institution hands a complete stranger hundreds of thousands of dollars, trusting them to send a check every single month for the next 30 years. Over 3 decades, a lot goes wrong. People lose their jobs. Entire housing markets crash. We've seen exactly what happens when borrowers stop paying, like the massive waves of subprime delinquencies that swept across the map in the mid-2000s. But banks do not gamble. A mortgage contract is a highly calibrated mathematical and legal machine designed to eliminate the lender's risk. This machine relies on several specific mechanisms to ensure the lender is paid. If you sign that paperwork without understanding how these variables affect your balance, you will end up paying tens of thousands of dollars more than necessary. The bank's protection begins at the exact second a loan is born, using a metric called the loan-to-value ratio, or LTV. LTV is simply the metric lenders use to compare the size of your loan against the actual market value of the property. A down payment functions as a mathematical buffer for the lender. By providing cash up front, you reduce the percentage of the home price that the bank actually has to finance out of its own pocket. Watch what happens if that loan block pushes past 80% of the home's value. Crossing that strict 80% threshold triggers mandatory mortgage insurance. This is an extra monthly fee you pay specifically to protect the lender in case you default. The math gets dangerous if the property's market value suddenly drops. If your loan balance becomes larger than the physical house's value, your LTV exceeds 100%. You are now underwater, owing the bank more than the asset is actually worth. So the loan-to-value ratio acts as a mathematical gatekeeper. It ensures that if the deal fails early, the bank has enough physical equity in the property to sell it and recoup their cash. Once the loan is active, the lender relies on a meticulously engineered schedule of debt repayment called amortization. This bar chart breaks down a single early monthly payment, and the split is highly counterintuitive. A massive portion goes directly toward the interest fee, while only a tiny sliver actually pays down your principal debt. Zooming out to the full 30-year timeline, you can see exactly how the banks structure this. They front-load the interest heavily into the first decade of the loan. As the years pass, the interest curve slowly tapers off to near zero. This structure is driven by pure behavioral data. Statistically, the vast majority of homeowners will either sell their property or refinance their mortgage long before they reach year 30. By front-loading those interest charges, the bank ensures its profit is collected early in the process. If you decide to move 5 years in, the bank has already made its money, and you are left holding the bag on the vast majority of your original principal debt. But what happens when the mathematical protections fail completely? When a borrower defaults and stops making payments entirely, the lender deploys their ultimate failsafe. This is foreclosure. It is the formal legal process lenders use to seize the physical collateral, your home, to pay off the remaining debt. How this plays out depends entirely on where you live. In states that use traditional mortgages, banks must use judicial foreclosure. This is a slow process where the lender actually has to file a lawsuit and prove to a judge that you are in default. However, nearly half the states use a document called a deed of trust instead. These contain a power of sale clause, allowing lenders to use a non-judicial foreclosure. This bypasses the court system entirely, paving the way for a rapid public auction of the property. Whether it takes a year in a courtroom or just a few weeks via a third-party trustee, the legal architecture exists for one reason: to liquidate the physical asset and make the lender whole. Once you clearly see the architecture the banks have built to protect their cash, you can start running your own offensive strategy. It starts with your down payment. Dropping more cash up front directly changes the loan-to-value ratio. By keeping your loan below that 80% mark, you dodge mandatory mortgage insurance and force the bank to offer you a lower interest rate. Next, you can directly counter the bank's repayment schedule. Making just one extra payment a year and instructing the bank to apply it exclusively to your principal balance changes the math in your favor. Because the principal shrinks faster, the bank has less money to charge interest against. You effectively bypass months of interest fees, keeping more of your own money over the long haul. The death pledge is intimidating by design, but by understanding the exact mechanisms the banks use to secure their return, you take control of the machine. You ensure the pledge dies on your terms, and absolutely not the lender's.